Welcome to the Simply Financial podcast. I'm your host, Christopher Calandra. So we find ourselves in the midst of another tax season, and today I just wanted to cover the basics of a standard deduction versus an itemized deduction. So to set the stage, tax deductions help you by lowering your taxable income. And when you lower your taxable income, this decreases your tax liability, so deductions are desirable. So when you file or prepare your taxes, you or your tax professional have two options to take either the standard deduction or the itemized deduction. So let's talk about the standard deduction. It is a set amount that you can deduct. For 2021, a single filer gets a standard deduction of $12,550. For married filing jointly, that number is basically double, $25,900. By the way, it's worth noting that if you're over the age of 65, your standard deduction is a little higher. Instead of $12,550 for a single filer, it goes up to $14,250. And for married filing jointly, it goes from $25,900 to $27,800. So let's just talk about an example. Let's say you're a single filer under the age of 65, and you make $100,000. When you begin to prepare your taxes to determine your tax liability, you take the $100,000, subtract out $12,550, and that is the first step in determining your tax liability. So that $12,550 of income is not subject to federal income taxes. So as you can see, you get the standard deduction. You do not have to declare specific expenses. It's very, very easy. You don't have to declare, as an example, your mortgage interest. You get the standard deduction just by being a tax filer. So it's worth noting that the majority of tax filers in the U.S. are taking the standard deduction, not the itemized deduction. So you could see lots of studies that demonstrate this. I looked at one from the Urban Brookings Tax Policy Center that estimates that 90% of households take the standard deduction, which also means, and I'll mention this at the end of this discussion too, is that most people today are no longer taking the mortgage interest deduction because if 9 out of 10 households are using the standard deduction, that means they're not taking the mortgage interest deduction, which would be if you filed as an itemized deduction. So let's talk about itemized. Instead of taking the set amount available via the standard deduction, you can instead list your deductions and use that total as your deduction amount. Now, you would only do itemized if the sum total of your deductions are higher than your standard deduction. That's how the game is played. Some common deduction examples are state and local income and sales taxes, property taxes, real estate taxes, although that grouping together is capped at $10,000. That's something referred to as SALT. So there is a cap. Mortgage interest, I mentioned already, is a common deduction example. That's unlimited. There's gifts to charity, as well as medical and dental expenses. So what you and or your tax preparer would do is look at your deductions if you were to itemize and add them up. And if it's less than the standard deduction available to you, you're going to use the standard deduction because that's a more desirable outcome that will reduce your tax liability the most. If, when you add them up, it turns out that it's greater than the standard deduction, well, then you're going to itemize your tax deductions, list them line by line, itemize them, and take the higher amounts, giving you less taxable income and reducing your tax liability. The neat thing is that this can change from year to year. There might be a year when the standard deduction makes the most sense, and then the next year, itemized may be more advantageous. You could flip back and forth seamlessly year after year. Again, huge myth today is that mortgage interest is deductible. it is deductible. But with the standard deduction a few years ago being increased significantly, most people are using the standard deduction, so you're not really using the mortgage interest deduction. So hopefully I made that clear. Thanks for listening to this episode about standard deductions versus itemized deductions. I hope you found this informative. I'll be back with you on the next episode of the Simply Financial podcast very soon. In the meantime, subscribe to the podcast if you haven't already. And as always, check out our website, elliottwealth.com. You could find out more information about the work that we do for our clients, helping them win with money. Thanks again.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.